Our session from operator to owner, own your real estate by leveraging HUD Loans, is now beginning.
All right. Well, we're going to go ahead and get started. So we have a really exceptional panel here today, and there's also a lot of us. So, 45 minutes, we're going to go briefly over this topic that I'm very excited and passionate to discuss with you. But each of the panelists that you guys see here, and we're going to do introductions here in a second, have been hand-selected because they have such a unique perspective on the topic that we're going to discuss. Today, the theme of this discussion is converting from just an operator with a triple net lease to becoming an owner-operator, and all the benefits as to why you would want to do that as an operator, and how to leverage the HUD loan program, the Section 232, in order to be able to do that. So I'm going to go ahead and start with introductions, and then we'll get going. So my name is Chris Imigel. I'm the CFO for Creative Solutions in Healthcare. I've been with the company since 2012, wearing various different hats. The owner, Gary Blake, is right there. I'm super blessed to be part of this discussion and moderate today. And I'll kick it over to you.
I'm Sarah Scott, a partner at Sternshine Legal Group. I started just a year before you, 13 years ago at the firm. And I work a lot with our HUD borrowers and operators and bridge loans heading to HUD as legal counsel.
Good morning, everyone. My name is Jason Dopoulos. I'm the founder of Icaria Capital Group. I've been doing bridge and HUD lending for now it's getting on 20 years.
Sam Bechtold, Chief Investment Officer at Aduro Healthcare. We operate 40 nursing homes from the Dakotas south to Texas.
I'm Scotty Clausen. I'm the co-founder of Calesta Healthcare Group. We're a regional operator in Northern California, and we operate now 27 facilities, a mix of mostly skilled nursing, but also some assisted living as well.
Morning, folks. I'm J.D. Stetton. I'm one of the founders of Carnegie Capital, and we're a mortgage brokerage for nursing homes and seniors housing coast to coast. We work with bridge lenders, HUD lenders, banks, credit unions to find whatever we need to get our owners and operators the financing they like.
Awesome. So the session overview today is we're going to kind of define exactly what is a HUD loan. And keep in mind, I like to classify and define this session as, becoming owner 101, owning your real estate 101. So I think in the future we might have more advanced classes, but we're going to start at the, very basic terminology and levels. And I think that the target audience that we're looking for here are operators that are considering and contemplating investing in the real estate and seeing the benefit from it. So, defining exactly what a HUD loan is. Then we're going to talk about lessons learned from, the lender perspective, the attorneys and operators. And then we are going to end the session on a really cool real-world example of what we are defining as a synthetic purchase option. So that's going to be a really cool walkthrough. So the first piece I'm going to kick over to JD. So JD, I know we've done a lot of business together. You were kind of initially one of the first mouths that I listened to as far as understanding kind of how this whole world works. And as an operator who we really had little to no experience jumping into the real estate game, you were definitely a key figurehead there. So I want to kick it over to you to kind of define exactly what is a HUD loan.
Sure. So as Chris said, there's a lot of detail here. We'll keep this high level, and I think all of us here in this panel are happy to talk to folks afterwards, dive into more detail here at the conference and afterwards. But we use the term HUD loan when it's more appropriate to say HUD insured loan. The government is not actually your lender. They are issuing insurance on your loan. It's an incredible product. Many of you have heard of it. most folks who've been in this long term, that is their goal, is to get their properties to HUD because it is a 35-year fixed rate, non-recourse loan. It is safe, it is low cost, and it's an incredible place to park your property for a lifetime.
So you had mentioned non-recourse. So explain exactly what non-recourse is and how that kind of varies from, let's say, more traditional lending.
Sure. Non-recourse is what lets you sleep soundly at night, knowing that even if things go completely upside down, haywire at your property, you're not able to pay your mortgage, there are events of default, it means that the worst thing that can happen is that you lose your property. Whereas in a recourse loan, which is more traditionally a structure you would see with banks, credit unions, QSOs, some other bridge lenders, you risk your personal assets. You, whoever else is guaranteeing the loan, if you default, if the bank cannot be made whole through the sale of your property, you risk them coming after the rest of your holdings.
So as we are kind of going through and we're talking with other operators, we know that oftentimes we're not exactly always strapped for cash. The cash that we do have and the margins that we make, which vary from state to state, a lot of times the money that we're producing is also being utilized as working capital so that we can continue to grow our operating business. Kind of describe the different types of leveraging and proceeds that you can get with HUD loans.
Well, that's another one of the chief advantages, and I know Jason can speak to this very well too, but HUD will underwrite and finance up to 80% of value, whereas most traditional banks and lenders are going to be capped at 70, 75 sometimes, and some of the deals we've done together too, Chris, when banks look at a nursing home and offer leverage, it's often based on the real estate value alone, and they're not always giving you full credit for the business value and the cash flow of the operation. So a 70% real estate loan is probably the equivalent of like a 62, maybe 65% overall leverage. So HUD's really an incredible high leverage player going all the way up to 80%, including the full value of your business operations.
Yeah. And one of the concerns about having higher leverage and higher debt is that it's expensive often to service that debt. So we want the debt service, the mortgage payments, to be manageable for operations. Kind of describe what you're seeing on the HUD loans and the amortization and how that kind of benefits the operator.
So that's another really strong point with our HUD loans. Most conventional banks and other funding sources look at nursing homes and they slap a 20 or 25-year amortization on them. And especially if you're dealing with maybe slightly older assets or maybe smaller non-primary markets, you're very often going to be hamstrung by a 20-year amortization, whereas HUD is almost always underwriting to a full 35-year. And the difference between a 20 and a 35-year amortization from a payment standpoint, from a debt constant standpoint, can be as much as a couple of percentage points. The difference between 4 and 6, 5 and 7. So it's a really drastic difference when it comes to your monthly payments. Not to mention, HUD is also always the best cost of capital in the nursing home business. So if bank rates are at 7.5, let's say, it's quite often the case that HUD rates are at 6 or 5.5 as they are now. So it's cheaper, and with the longer amortization, your payments shrink as a result.
Thank you, JD. So now I'm going to kick it over to Sarah to talk about some of the, maybe not so great things about the HUD lending program. The regulatory red tape, we have spent a lot of time and money and been very intentful on building out a team that goes through all the steps involved with, submitting HUD loans. So Sarah, is going through all the steps, is it worth the headache?
Usually, but not necessarily always. Each piece of property is unique, and there can be some unique issues that you might have, and HUD tends to have more stringent requirements. So you're getting these, 25, 35-year loans in exchange for having to have a beautiful and perfect piece of property. And if you don't have that, it may not be worth taking it to HUD. So you want to speak to your lender about the details of your real property to make sure it's something that is worth it.
Yeah. So one of the questions that a lot of people have is, do I need someone that specializes in HUD from a legal counsel perspective? And if today that answer is no, when does that make sense to go ahead and make that investment?
Okay. You always will need an attorney, and I'm not just saying that because I am one, but your bridge lender will require an opinion of legal counsel, and HUD will ultimately require an opinion of legal counsel, and that's just the minimum. Getting your attorney involved early can save you time and money. We've just been through the process many times. We know the forms and what HUD wants to see. So I know that attorneys, you look at it as an expense, but that expense can save you time and money later down the road.
Yeah, I would add quickly, the government doesn't react well to changes to their documents. So, I always tell my borrowers, you don't want to train someone, right? Because then you're just going to pay more. So a lot of borrowers will have local counsel working with, they can maybe do the local opinion, and you bring in someone that has expertise, and it ends up saving you money, right? Even though you might say, oh, I got to pay $30,000 for this. But if you train someone on it, it'll cost $50,000, just
right.
from my experience.
Yeah, that's great. So kind of in that same realm, you'd spoken to me previously about building your dream team around kind of as you're getting there, you're prepping your organization to start, shifting from just operations to now operations and real estate ownership. And you had spoken to me about Dream Team. So tell me a little bit about that and describe to me what you mean when you talk about Dream Team.
In general, it's a team of people who will work on your loan who know what they're doing. That includes your counsel, but also your title and escrow team, your surveyor to make sure that they can provide a survey that meets HUD's requirements, and your depository bank. So all of these players having some experience in the area can just make it more efficient.
Yeah, we've had our share of, just snapping on different titles and depository banks and having to go through the steps of having to teach them how to be HUD compliant. It really does add a lot of time and headaches to the whole project. So speaking of the bank side, let's talk about some of the DACA do's and don'ts, because I know you've talked to me several times. That's a big holdup. And I guess real quickly we can go ahead and define DACA as depository account security agreements. These are things, since the federal government is insuring the mortgage on these, obviously they want to have, ultimate control of the depository accounts and things like that. And Sarah, just kind of describe to us kind of what you see done right, and when that is done wrong, how that kind of looks.
I think it's in general working with a bank who understands the HUD requirements for DACAs and DASAs, and who's willing to make changes at points when the HUD attorney or lender's counsel come back with changes to make those agreements comply with the HUD handbook. So I think the biggest do is get your relationship with your depository bank on the operator side, establish that they can provide those HUD compliant DACAs, and the biggest don't is to don't wait. Tackle that issue early on. We've found that it's generally a lead time issue, and something you've addressed 7 months ago can end up holding up your closing.
Fantastic. Thank you so much. So now we're going to kick it over to Jason, our lender of the group. And I do want to start with an obligatory kind of market overview, kind of talk about, the 10-year yield as you see it today, which ultimately reflects the, long-term debt financing. So what are you seeing today in the current markets?
Yeah, so in the last 6 months, so just for the basics, because this could go down a rabbit hole.
Sure, sure.
HUD loans are typically track the 10-year. They don't track it lockstep, but over the years, it's been, 150 to 250 basis points over the 10-year, right? When rates are really low, investors kind of compress their spreads. When rates go higher, they kind of, increase or decrease accordingly. But right now, the Treasury around 4 was 450 6 months ago, so that's good for everyone that's been in the queue. On bridge loans, they're priced off SOFR, which is the short end of the yield curve. That's when everyone hears about Fed cuts, right? If you have a floating rate loan with your bank, that's where you see the immediate savings. That rate's around 4.25 right now. So really, we still have kind of like a slightly inverted yield curve, which usually, historically signals a recession. But it's so crazy now. My clients call me the Fed cuts rates, the 10-year goes up. I'm like, I don't.
Yeah.
I have an economics degree, but it really doesn't matter anymore.
Right.
So it's all over the place. But right now, JD said, rates are probably, in that 550 range. And, if you're borrowing with a bank, that's, if SOFR's 420, that's SOFR 130. No bank's giving you that deal, right? Usually the banks are what, JD, threes, low threes?
SOFR 3.
Yeah, so, even for the best borrowers. So it's, it's getting better. And no one can predict where it's going to go, but the thought is that, inflation's kind of under control, and we hopefully will keep ticking down a little bit.
Great. So we've kind of discussed a little bit previously about purchase options, and it's such a vital part of the transition from going from operator to owner. Purchase options is obviously one of the most frequently used tools to get there. Kind of define for us, purchase option pricing, the difference between fixed pricing, fair market value. And then I also would love for you to kind of give us an idea of what the ideal purchase option language looks like if HUD financing is something that you have in your aspirations, and then maybe some language to kind of wear you away from as you're negotiating those.
Yeah, I think the first step as an operator is you're going to negotiate with your landlord, right? A purchase option. Some landlords won't give it, some will. If you're taking over a stable asset, that purchase option might be fair market value, right? But if you're coming in, like you guys have done so many times, to a turnaround, ideally you want to structure your purchase option to be a set price. Because when HUD interprets it, if they think your purchase option is value, they're going to cap your loan off the theoretical value, right? So if the value's, if your purchase price is 10 and HUD reads the lease and that says that's like a value calculation, even if it's worth 12, they're going to say you can borrow 80% of 10, right?
Right.
Or they'll make you wait a while on a bridge loan to get to HUD. So what I always tell my borrowers is, try to get a specific price in there, because then we as the lender can say, well, Chris came in, NOI was here. This obviously is a below market purchase option. It's not the value. That way, and we'll go through this example, that way if JD structures a bridge loan at 100% of cost, but 70% of value, we can then take that to HUD. So if you have a purchase option, it's good to talk to your counsel or your lender, or if you're structuring that language when you're entering into a lease, to make sure it reflects very clearly that the word market doesn't exist like anywhere in the purchase option. Because HUD they'll fixate on that and they'll be like, oh, no. This is the value because you're the expert, you're the operator. So that's kind of what we want to avoid. And then also in the leases, language about CapEx you put in, working capital, document all of that, right? Because that's going to be eligible to refinance with HUD. Because HUD will refinance all the costs, which include, if you take a turnaround and you're posting $500,000 for a lease deposit for working capital, that counts. That should be added to the purchase. That should be included in the value that you get to take to HUD.
Yeah.
So some of the HUD stuff's an art, right? There's rules, but then there's like, these people, if there's precedent, they'll just check the box, like, oh, looks good, right? And so we just want to structure it where that person picking it up who's underwriting 50 deals can just say, oh, that looks like the last one we did with creative, we're good to go. So to the point about talking to your counsel and lenders, it's just there's so many weird rules and holes you go down with HUD.
That's right. Okay. Well, you had mentioned a little bit about, the CapEx dollars, and I think it's really imperative that, you're tracking those, as before you execute on a purchase option. But to operators out here, what are some best practices for, documenting trailing NOI and making sure that you are staying on top of that to make sure that when you're within that clearly defined window, you can know that you're in the money per se.
Yeah. So on CapEx, historically, HUD's let us look back 3 years. And so if you don't keep track of it, it's difficult. So keep the receipts of what you've done, because we can say that's good money for the operator. Same with losses, right? I mean, it's easy to show your NOI, we lost money, but that's not good enough. They want to see what did you transfer from your operating accounts, what have you lost, and just to keep track of all that, because then you can make a very easy case for HUD to accept those costs, to reflect in there. I mean, with NOI and tracking it, that's where, we talked about defaults. HUD only has a 30 basis point default rate, and that's because to get in the program, you need a strong trailing 12 NOI. So you want to monitor that. HUD will allow some adjustments, like if you get a Medicaid bump like Texas did, you can underwrite to it. Yep. There's other unique issues that we won't go into today. Some of your favorite topics on QUIP and other points that we're trying to work with HUD. But that T12 has to be solid. You work with your lender, get that where there's some adjustments that can be made. Like HUD won't allow for any COVID hangover. You can't adjust for agency anymore.
Yeah, exactly.
But it's you when you can go. You time it. Sometimes with HUD, we know the queue's 6 months. So if you have a T6, we get you in the queue. So you're timing you come out looking great. It's like a first date. When they pull your underwriting, you want to look good the first time they pull it.
Yeah.
You don't want to show a couple bad months, right? So that's what we want to make sure you do.
And that's where having a debt broker and someone advocating on the underwriting side, to help also offset what the lenders are doing on their underwriting side has helped out, right? So I know JD's been a big help on our side for that. The next perspective that I want to kind of have is, I'm going to kick it over to Sam, who's currently in the process at Aduro of transitioning, buildings from just operating to ownership operating. So I guess I'll start with, what are you seeing from a timing perspective, with, going from bridge to HUD, from when you guys are submitting that application, or how long is it taking you after you close on the bridge to submit the application? And then once it's submitted, how long are you seeing until you get, full closing on the HUD loan?
Yeah, I mean, it's an interesting question. We're still sort of working through our first couple of bridge deals, and I would echo what everyone else is sort of set up here. Have people that really know what they're doing. So, for us, we're working through some preliminary bridge numbers, but I mean, I think it's always longer than you expect. That's not really an answer, but for us, if you think it's going to be 6 months, plan on 12. Right, and part of that is just because there's so many things to get in order, and then just on the underwriting side, from an NOI perspective, EBITDA perspective, whatever number you're looking at, it's just you just need to make sure that you're tight on what that is. We ran into an issue, just with QUIP in Texas. You sort of mentioned that, but sort of overvaluing what we could use from an EBITDA perspective. So that's taking us more time to sort of work out and get our normal EBITDA a little bit higher because we lost some value on QUIP. So, I'd say for us, plan on minimum 6 months, but they might be able to answer that better.
Yeah.
And the only quick thing I would add is with the government shutdown, right?
Right.
Only committed deals have been closed. So the whole industry is working on their deals. So they're submitting them still. So when the government opens up, there's going to be a huge line. So if you're doing a deal right now, whereas you may have been in the queue for 3 months, it might be 6. Then the lawyers get backed up. I mean, we had this happen a couple years ago. Just be wary. If you have any maturities coming, work with your debt broker or your bank and try to get extensions, because you don't want to, just try to get that extension early, because it's going to be kind of messy.
Yeah, not necessarily bridge, but we're doing a couple of HUD TPAs right now, and those are dragging as well. So
Right.
I think just HUD in general is always
Yeah.
longer than you think it's going to be.
And for the group, do you want to kind of just briefly define the TPA process of HUD?
Sure. Just a loan assumption. I mean, I don't know. It's a transfer of physical assets. So, we've got a couple of buildings that essentially aren't worth more than what the HUD loan is at, and so an owner is walking away, more or less, and so we're taking over, assuming that HUD loan.
Yeah.
And most of the time, the lender stays in place, and you're just assuming that HUD loan at whatever the basis and rate are, at the time the deal was struck. So, for us, that's been it's not necessarily a bridge, but it's been a good way for us to get a couple of HUD deals this year.
Absolutely. I mean, I know that the TPA, that's definitely something that, we've benefited from assuming those notes. It's a strong aspect of, a HUD-insured loan is to be able to assume a note, especially with kind of the, high prepayment penalties at the very beginning of the HUD loans. But it does take a long time. Yeah. And my experience on those TPAs is, the outgoing operator or owner, they're slowly checking out of the building. And so it's something that you want as, if you're in Sam's position, you're in the process of assuming a note, you want to make sure that the incumbent is keeping track of the house, and that, the operations doesn't start slipping and sliding while you're going through that process, because it could take, the fastest one we had was probably 3 months, and the longest one was about 14 months on the TPA. So there's a wide range for how long it takes to get processed.
Yeah, and also the only thing I'd add is that HUD has their production staff working on new deals. Those are like the entrepreneurial go-getters. Then they have the asset management, which is like the B team, kind of.
Yeah.
So they're the ones doing the TPAs, and it's hard to push them because
that's interesting.
they're not the production people, right? So you have to be really delicate. It's kind of like the DMV at that point. You want to be nice. So that's why we're trying to fix that as lenders, because sometimes the building can deteriorate and affect the residents, HUD-insured property, and we want you guys to get in fast, because as a lender, I'm like, I want to get a deal in now. Yeah. It's so frustrating, but it's just tough.
The TPA, and I'll jump in too, the TPA also, you don't have to be the current operator. So we've had a couple of deals, one deal in particular where they had the HUD loan, they had a valuation of a high valuation, got it to HUD at a good price, and then over a 10-year period, they started to not operate so well. It's an assisted living. So they really needed this purchase price, to get out, but we couldn't find financing for it. It was going to be a massive cash outlay. But we found out, okay, it's a HUD deal. And at the time, I didn't know there was the TPAs. It's assumable. So, we can go in, and the value of the HUD loan, they still have this massive value on the HUD loan. So, it was instead of coming out lots of cash and trying to get financing and super high leverage or super high interest rate financing, you can assume the loan and only come out a little bit of cash. And so that's a pretty special thing where some deals don't look like they make sense, but able to make it happen.
So, Sam, my next question for you, obviously, especially when we get into the next slide, we're going to understand about how having strong relationships with your landlords is important. So I'm curious from your perspective, what are you guys doing to facilitate those relationships with your landlords, and where do you see that utility as you're kind of shifting from, being tenant to owner as well?
Yeah, I mean, I think landlords, whether they're REITs or family offices, they want predictability. They want transparency. And so that's where, for Aduro, we really pride ourselves on those relationships. And we've, over the years, we've had to have some hard conversations with landlords, but invariably they've always appreciated that we've, done what we said we're going to do. And I think, a building in Texas, for instance, we don't have a purchase option, but the landlord, we came into a tough building and, had turned it around. And as a result, they don't want to be in it long term and have given us an option that didn't exist. It's not a formal option, but essentially said, you guys can buy this property at X. We want to be done. And I think that's because we came in and sort of bailed them out, turned the property around, and it's worth, today they can at least get out for what they're into it. Yeah. And so that's an option that didn't exist because we've created this relationship with the landlord that's not in the SNF space and just saved them essentially. So, for us, it's transparency and it's predictability.
Yeah, and I know one thing that in the discussions that I've had with our landlords, they are very open-minded with their tenants having real estate investments because it strengthens their balance sheets, right? It strengthens the guarantees that they have on their leases. And so I have several of our landlords that don't necessarily see us converting leases to ownership as a threat. They actually see it as an opportunity to have a more financially sound guarantor. And so that's kind of the way that I pitch it sometimes. But it's definitely something that I think even the big REITs in this world are very keen on now. So.
And one thing Sam said to tie back to the slides before, so in that scenario, you'd want to amend your lease now, even if you're buying it in a year or two. So if HUD says that's market value, you have the argument that, well, that was 2 years ago, it's worth more now, right? Yep. So like all those kind of things you want to try to get in your lease because you don't want HUD to say that your price where he's giving you a deal is market value, right? So that ties back into the structuring.
That's great. Well, now I want to shift on to the exciting part of this presentation. So, Scotty, synthetic purchase options.
Yeah, so I mean, when we started off as a new operator, we were really naive. Luckily, we were really naive, or we would have never left. But we were naive about a lot of things. But we always knew we wanted, we knew a great way in. We had good relationships with Care Trust REIT at the time, personal relationships with people there. And so we knew that was an amazing way in to get into operations. And since then, we've met other wonderful landlords that we have great relationships with. But we were in no position to ask for purchase options at the time, right?
Right.
I mean, and so we knew we wanted to get into real estate, but I think we underestimated how competitive the real estate market was, especially in Northern California, California in general. We underestimated the cash outlay that was required, the leverage that you could get with loans. And we underestimated, the comfort, the ease of financing. It was difficult to get financing on value-add properties. Facilities that we would mostly take over are facilities that were failing, that needed to turnarounds. And so, we were starting to get, I don't know if discouraged is the right word, but just maybe a little discouraged, or maybe just thinking maybe real estate isn't going to be a big part of our business. But I think one of the other things that I was naive to or I didn't understand is the unique position that the operator has, that for for a landlord, that with an in-place lease, especially these long-term leases, we've got 15-year leases with 2 5-year extensions a lot of the times. You're 3 or 4 years in. For that landlord, for them to go sell it to anybody else, the value of that building is tied to the lease yield, right?
Right.
The only person that it's different for is the operator. So the operator, the value is tied to the EBITDAR. And so we had situations where, our first kind of real HUD deal was this facility, our second facility we got in Menlo Park, California, in Atherton. And it was a very expensive building. We went in, we turned it around. We would have never thought that we could have afforded that facility, right? And yet over time, we approached the landlord without a purchase option, and a couple of different times approached him, hey, this would be an amazing thing for us. We really love this facility. Would you be interested in selling it to us? And the first time it was no, flat out. The second time it was, yeah, but it's going to be a lot of money. And so we're, okay, what does that look like? And so he told me a number, and then that's when I started to call and reach out. And that's one of the main takeaways, I think, is just reach out early, don't be shy, learn, if you're an operator, all this piece is it's very foreign for us as, former administrators. And so there's lots of really wonderful people that are there to help. So, I was just transparent, said, hey, we can probably get this, but it's going to be this number. And, some great people that knew what they were doing went down and looked, and they said, hey, you're not there. You're not, you don't have the DAR for it, but this is where you need to be. And so then we had a target. So over a 12-month period or 24-month period, we got a great trailing 12 or a great trailing 6, and got to the point where we could get into it. And it ended up going so well that at that particular facility, we didn't come out of pocket at all. And we were able to recoup, put a bunch of the CapEx and initial losses of the building onto that loan. So it can be a really amazing thing. And I would say just because you don't have, every landlord's different, every situation's different, but just because you don't have a purchase option doesn't necessarily mean that it's not going to be a win-win for both parties, or that it's not possible.
Absolutely. No, that's an incredible success story, and I love to hear stories like that where you're getting into I won't necessarily say it could be a turnaround asset, or maybe it's just an asset that before you got into it, it was undervalued from the hard work and the effort that you put in as an operator. And then, to be able to turn that into equity on the real estate side for virtually no owner's equity on the front side, no cash outlay from operations. That's an incredible story. And obviously, the landlord, the seller, it was a win for them, or else they wouldn't have agreed to do it in the first place. And so I think, the market in general has been very bullish on this sector as of late. And we've been seeing rate increases happen all throughout. We're seeing countless wins on valuations. I know, Sam, you had talked about the QIP and that piece. And when EBITDAR is not necessarily EBITDAR. I tend to think that as this industry matures and we start having additional program funding that is outside of core Medicaid, such as the Texas UPL, the Indiana UPL, and there's other states that have it as well. There's going to be a call for modernization in the valuation perspective, because I think, overall, this industry we've already seen the shift away from fee-for-service, and you're going to see a lot more quality-based programs, and it's real dollars and real money. And Sam, I sympathize with you on that piece where you're not able to capture that full EBITDAR from that perspective.
I think it's important. You'd mentioned it. There's a lot of lenders that we've reached out to for opinions, and for me, even sitting on this panel, I'm sure there's folks out there that are trying to catch the acronyms and what everything means. But for me, I've said several times, tell me what EBITDAR I need to make this value work, and walk me through just a very basic Excel model, or here's what you need. There's just so many acronyms and so many pieces of this puzzle that the most helpful thing for me is not talking with someone. I'm a visual learner, so just build me a very simple model and show me what my EBITDAR needs to be to get to this value, and walk me through the steps. That was super helpful. CFG's done that with me. James Scribner, these guys have both walked me through it. Jason's been great. Don't be afraid to ask questions, and sometimes I feel like, man, I look stupid right now, but there's a lot of pieces of the puzzle that, coming from a triple net lease perspective, is super helpful to have somebody walk you through it.
Absolutely. And we're blessed to have such a great lending community in this space, and they're always so eager to provide that feedback. And Scotty, I'm sure that's who you were talking with when they were kind of telling you what EBITDAR you needed to get there.
Sorry, buddy. You're not.
Yeah, exactly. They're great to lean on. So those lending partners, this is what they do on a day-to-day basis. Folks like Jason, and so leaning on that expertise, it's vital. So we've talked a little bit about negotiation framing. Where you've gone, Scotty, from no to yes, maybe to ultimately yes. What are some other advice points before we actually get into the example?
Yeah, I will say some of the things to think about. I mean, in every case that we've had so far that we've gone from, a lease with a landlord to owning the real estate, the debt service is normally, it's higher typically than what the lease was. And so, that has an effect on the operation, on the EBITDA and the NOI of the facility, right? So that's one thing that we've as I think a lot of people in the industry are, trying to protect the performance of the facilities. I mean, our administrators are bonused and compensated based on the performance of the facility. So at times it's drastically different, the debt coverage, and it's a good thing for us. But, we want to be, aware of that, and at times we've made adjustments to how the administrator is compensated or kind of made up for that a little bit, just not to de-incentivize the operation.
That's great. Yeah. So now we're going to kick over into the synthetic purchase option example. JD, I'm sorry, that's really small to see up there, so I hope you've kind of got most of the numbers memorized.
Yeah, I was just going to say, I was visiting my PCP the other week. He asked about vision. I was like, it's great, but looking at this slide, I might have to call him up again. So this is for our visual learners, like Sam and others. And this is based on a real and recent example with an operator, now owner, sitting in this room on this panel. We don't have to name names. And if you look towards the right, you'll see what Scotty was talking about in terms of the value to the landlord or to another prospective buyer based on the lease. You can do that two ways. You can look at the remaining term of the lease. You can NPV. I think we use the 6% discount rate. I mean, heck, you could use a 3, you could use a 10. Ultimately, in this case, based on the remaining time in your lease, you're getting a value. We average the difference between the two ways, somewhere between $9 and $10 million, because of the fact that you have that many years left, sometimes even with extensions that go beyond this, on the existing lease. So to the existing owner, this is the value that they are locked into, maxed out on because of their obligations under the lease. Now, if we look in the other side, on the left side of the slide, you see what the DAR value is. And this is a great example of an operator came into a building that was underperforming and created this value through their hard and great work. And that's using a standard, 12.5 cap rate, which is industry HUD, at least HUD standard. Some of our banks go a little lower, but so we have a really nice discrepancy between the two. And in this instance, our operator went to the landlord, made the case gracefully, and we found a value in the middle that got the landlord greater value than their lease fee, what it would be worth, and still left so much value for the operator that because of that, we were able to finance 100% of this purchase price plus closing costs, keep it under 70% of value, which means that we were able to sprint to HUD immediately. We can get into, and I think Jason maybe will talk more about that on the next slide, and we can talk if anyone's interested after this presentation. But that enabled us to get this deal 100% financed and taken out to HUD within the first year.
And just real quick before we flip over, the comparison of the debt service on that relative to the rent that they were paying was virtually the same.
Yeah, so to the operator and owner, it did not increase their monthly costs in any way.
Okay, so now we're going to go to the second example, and I'm going to have Jason kind of walk through this one. A little bit more complex, but it's just a different value proposition here.
Yeah, so that same deal, if you recall, JD, we're going in at 67, 70% of value. So you could go right to HUD after that, right? You're the operator. You don't have to wait a year because you're still the operator. You go to HUD. You put it to bed at 70. That might be your goal. Fantastic, right? But if you see here, with the EBITDA, the HUD value is 18.4, so the max 80% LTV loan is 14,720 for HUD, right? So there's something left on the table. So HUD doesn't let you take equity out or dividend in senior living. They do in multi. We're trying to fight this, but it's not going to happen, so we can't do it in seniors. So you got to structure it correctly. If you do a HUD loan with a bridge and take equity out, you got to wait 2 years to go back to HUD, right? Which is, interest rate risk. You might be on recourse on that bridge JG set up for you because it's 100% of cost. So what we like to do is on that bridge loan, we structure an earn-out just into the loan documents. The bank or bridge lender or us may not give that to you right away, but for HUD, if it shows up on your loan agreement, that starts your 2-year clock. So if you continue to improve and you want to wait to go to HUD, instead of waiting 3 years, you're only really waiting 1 more year because HUD takes a year anyway. So in this scenario, you'd be able to get right a $2.42 million earnout, and then get to HUD and put that in your pocket, go buy another building, whatever you need to do. So it all goes to just the front end structuring. So you want to work with JD, with that bank. Some banks don't like to do that because they have to reserve the capital, but private lenders really don't care, or mezz lenders, you could put a second, whatever you need to do to make sure you can get maximum with HUD, because HUD will go 80, right? Some borrowers don't want to go that high. It's totally up to the borrower, but this preserves the ability to do so.
Yeah. So just in short, if you want to continue the play of, basically being rewarded for your efforts, and you're okay with sitting in bridge for a little bit longer, 2 years, then instead of having no owner's equity, no cash down, you can actually receive a cash out for that gap in equity, right? Instead of going in at 70 straight to HUD, you can receive funds in your pocket for that transition and still get, all the great things of HUD just a little bit longer than what it would be if you went straight to HUD. So, well, that basically concludes. There's the key takeaways, but I do want to reserve, because we are a minute over now, some time for some Q&A for anybody in the audience that wants to pose any questions to any of the panelists here. Okay, easy peasy.
All clear.
Yeah. So yeah, absolutely. I think, anybody that is currently contemplating that this is the direction that they want to head with their organization, they see the value and the utility of increasing their balance sheet on the real estate side, providing more enterprise value there. These guys that are up here at the panel are incredible. They, so many different perspectives, so many different expertise. It's an eclectic group. Don't hesitate to reach out to anybody here. If you need a HUD attorney, Sarah Scott and her firm, they're not newbies at this. Like I said, creative solutions. We really leaned on early from the very beginning, a relationship with J.D. Stetton and just having someone kind of navigate all those lending partnerships. But I would say that for conferences like this, network, figure out, people that can give you advice and utility. Maybe it doesn't have to be deal specific. Maybe you're not even that far along in your journey. But that's what these conferences are for. Building networks and relationships to ultimately benefit your organization. But anyways, I want to thank all of y'all for coming, and I really hope that you guys took something back from this. So,
Thank you.
Thanks.